Welcome, everyone, to the next Red and NYC virtual networking event. We're just getting our sound and everything set up here. I am live today with Gavriel Kahane, who is the CEO and co-founder of Archouse Partners, which is an opportunistic private equity fund. Really excited to be sitting down with you today, Gavriel, and I know we're going to have a great conversation about where investors can actually find opportunity. So welcome.
Thank you. Excited to be on. Thanks for having me, Carly.
Before we jump into what promises to be great content, I need to take a moment and thank Red and NYC for, of course, having both of us on, and also to our sponsors who make events like this possible. That would be CNA Seneca Construction, Skyline Scaffolding, DNA Construction Advisors, Champion Elevator, Remax 100, City Bay Capital, Property Shark, Hydrotech Environmental, NYREM, The View, Real Estate Promos, and Clean to Clean. I think we got everybody.
Thank you all.
Yeah, exactly. Thank you all for letting us be here to share our thoughts. So we don't have a ton of time today, and there's a lot that we really could cover because there's just so much change going on in the market right now. I think it's a very unnerving but very exciting time as well. So why don't you start by just giving us sort of a general background and overview of Archouse, how you got started, and what your philosophy was pre-COVID, and then we'll jump into how that's changed.
Sure, absolutely. So Archouse Partners is a generally opportunistic, special situation focused real estate investment group. Private equity, generally focused on trying to be problem solvers, and kind of those special situations to date. And by to date, I really mean up until, this post-COVID or, COVID era, have been property level. So we've been very focused on really just trying to solve problems for, for a prospective borrower, prospective partner, or seller, on a case-by-case basis.
So you, from what I've heard, have been able to achieve some very impressive returns for your investors pre-COVID in what has been an incredibly compressed cap rate environment. So walk me through what problem solving really looks like and how that translates to increased yield.
Yeah, sure. It's hard to make money in a frothy market. And for us, the way we approach the problem is, like I said, trying to be problem solvers. So what that means is really approaching deals creatively, and without a blunt tool, but, with really specific tools catered to each specific deal to flex ourselves and, often into strange contortions to really accommodate someone else's need. So sometimes that's just moving quickly, and saying, this is my typical underwriting list. I'm going to throw out this bottom half because my basis is so, strong in this deal that I know each one of those could go absolutely wrong and I would still be okay. To kind of seeing situations as safe or risky. So, underwriting litigation, for example. A lot of investors would just shy away on the basis of there's litigation involved, not for us. We sort of felt like we didn't have the luxury to do that in such an overheated market. So we, tried to find areas where other investors weren't comfortable going, but we thought sort of their concerns were surface level, unwarranted. And, and with some digging, underwriting diligence, we're really not all that scary. And for us, like you said, that's really translated to, we think, pretty outsized risk reward offerings for our investors.
So if your business model is problem solving, you must be having an absolute field day right now in the middle of COVID, because there are what to me is the start of many problems and will be many, many more. Not that we want to capitalize on anyone's misfortune, of course, but there will be a lot of sort of, let's say, equations that need solving coming up that are already presenting themselves. How do you expect your strategy to change moving forward? I'm sure you've already had a good bet of thing in the last 5 months, but what have you done already, and what do you think the next year will bring?
So so how do we expect it to change, and what do we expect the next year to bring? So I think it'll change dramatically. I think the world has changed pretty dramatically, and I think it's changing, and our strategy and approach changes with it. I would say really the only consistent thing about the way we sort of looked at our, pipeline of prospective acquisitions, in February to today, or to, mid-March, is really that we were always trying to be kind of open and flexible to pivot to, to new deals, or to new strategies, to new opportunity sets. I think what's changed is kind of where we expect those opportunity sets to express themselves. So, kind of as investors, we think we sort of have, a dual moded approach to acquisitions, sort of two kind of different acquisition worlds. The first is what we've had really, for the last decade or so, certainly for the last 5 years, where you're adding value to real estate, right? You're looking for special situation deal level opportunities to increase earnings. So, like an interesting analogy would be, in the equities market, there are traders who are growth oriented and focus on earnings growth, and traders that are, deep value investors. So to date, we've kind of been in the earnings bucket. Our acquisition strategy has been, how do I approach this deal to add value to it, and in some cases, solve someone's specific deal level problem. And on a forward-looking basis, we kind of expect to be wearing that, deep value hat of, I'm going long this market. I am making a simple bet, and in some ways that simple bet gets very complicated. When you get sort of down to brass tacks, but a simple bet that, in the case of New York City, that New York City is not forever over. And we expect there to be opportunities for that type of investing soon. Those have not really surfaced as we see it yet. We kind of think we're in what we at Arc House have been calling, a first wave recession. And, our expectation is that there's a much bigger, second wave, coming from behind us, a giant 80-footer that we'll have to contend with soon. So for now, we're kind of trying to find opportunities in that first wave, while, being very cognizant of the second one coming. So, those opportunities, for example, have expressed themselves across asset classes. That first wave of pain, is really the direct COVID-induced pain. So, hotels losing all of, or most of, or some of their revenue. Hotels, operate for the most part at a pretty tight margin, profit margin to begin with, and you turn a little off and it hurts. You turn a lot off and it's unbelievable. So of course there's been a lot of kind of short-term pain expressed there, but we don't really see that pain as recession induced. In fact, it and the recession to a large extent share the same cause, potentially, right? Coronavirus, really, right? And have the same catalyst. but it's not really the recession that we're experiencing today. So we're very careful to sort of, not fall for the head fake that is a market recovery today, but still, kind of, to go with the surfing analogy, wax our boards and stretch, and maybe take it out on a few of those, shorter first waves. But again, still really having our eye to that bigger wave where we think there will be more opportunities for real deep value investing in New York.
So you touched on a lot there. So I want to
yeah, sorry about that.
No, it's okay. It's good. It's good information. So let's start with New York specifically. We are both based in the New York area, so we have a lot of firsthand knowledge, a lot of clients here, a lot of deals that our team has done here, and obviously this is, I believe, really the core of your market investing.
Yeah.
What's your overall view on New York as a market? Let's start with just sort of the concept of the exodus to the suburbs, the retail. How do you see New York ebbing and flowing in the near and long term? And
yeah.
let's break that down by asset class.
Yeah, sure. So New York's in pain right now. New York's in a lot of really deep existential pain. And I think some of that pain would even be more acutely expressed if not for, artificial sustenance of the status quo. Just forbearance and kicking the can, and we'll see how things ultimately play out. The short-term pain that New York is in today is expressed across asset class. You mentioned the exodus out of New York. That is having a massive impact on multifam in Manhattan, on the rental and on the condo and co-op market alike, really. It's definitely, anyone out there who wants to buy.
1 second. Do you think that's going to continue, or do you think that's a sort of shock response where people are worried about being in the city temporarily and then they're going to flood back, or do you see that sticking?
Great question. Yes. I think both. I think in the same way that, we had some exciting jobs news of regaining jobs a few months ago. And I think that was like a really nice illustration of, I think, what we're going to see a lot of. Those jobs that we regained were the easiest jobs to get back. So, coronavirus did two things. It made people want to be out of the city, right? It made there forces pushing people away from Manhattan, which are urban density anxiety, let's call it. And then there's just a lack of the stuff that pulls people into Manhattan, right? Both of those things are going to have a short-term and long-term impact. A short-term impact because there are a lot of people like myself, we're in northern Jersey, not too far from you. On a temporary basis, our plan is to go back into Manhattan, but because of, the state of Manhattan today, we were not, it was tough. Every time we go outside, we have to mask up, we have to sanitize our two boys. Don't touch that. You're too close to him. You can't play there. Here we have our own backyard and our own space, and we feel much more at ease. Ultimately, we're going to come back like many others will. But it's also had a longer term impact, I think, on housing, in that it's expedited the plans for families who are considering moving out of New York City over the next 10 years. Right? So anyone who had it within their theoretical framework, we love the city, we might want to leave, we might not want to. Those people left. And of course that's, I'm exaggerating, it's not 100% of those people left, but so many of those people left either to a rental home, to a home they already had, or to go and buy a home in the suburbs. And a good percentage of those people are not coming back because they had it within their, next decade plan to leave anyways. So
argue to that point, though, that there's a whole other wave of people who, when rents come down a little bit, are on the flip side of that coin, that they're dying to get into Manhattan and seeing this as, maybe this is my opportunity?
100%. And I think it's always the case that when New York City suffers, on vacancy, there's sort of like there's an ebb and flow. There's a, expansion out and then a contraction back in. And that typically benefits the more established neighborhoods. More pioneering neighborhoods take longer to recover because people, like you said, like, what, I could get a penthouse on Fifth Avenue for $250,000. Like, okay, maybe exaggerating, but yeah, I'll send you the listing.
Yeah.
For sure, that is definitely the case, and that's sort of my our bullishness on New York is exactly that point. I think not just on the residential side, but across the board. Ultimately, it's just a question of basis, right?
Mm-hmm.
Like, there are so many people that want to be in New York City, investors and companies and individuals alike, families, etc., that want to be in New York City and Manhattan specifically. They're not exclusively, and when they see pricing come down, they're going to be like, "There's my pitch. I'm going."
Right.
But I think there's going to be a lot of pain until then.
I agree. Short term, very different story. Long term, the city will come back, if we were to summarize.
Exactly. Yeah, totally. But I think we need to be careful that short term, we know that short term is not just short term direct COVID, what we call first wave recession, but also short term, kind of real recession,
right,
which is coming down the pike. At least from our perspective, I really hope in almost every respect that I'm wrong.
Right. I think we all do.
Yeah.
Talk to me about something you touched on briefly, which is the variation in different asset classes. I think it's obvious to most people, of course, that hotels have been hit pretty hard. What are your thoughts on industrial, retail, office? And we can keep this to the New York area if you like, or make it broader, but kind of touch on where you see opportunity and risk across the different asset classes.
So kind of in this, second mode of acquisitions, we don't see that many opportunities. We're not very bullish on asset classes, but for industrial or pockets of industrial, specifically last mile, and single family housing. Those are two, I think, kind of asset classes, let's call them, that have real tailwinds. Other than that, I would say our bullishness is really only kind of relative bullishness. In other words, like our deep value type of approach of, while everyone's yucking this, we're going to yum it because they're over yucking it, right? We don't like to be contrarian, because it's cool, but we think that the market tends to overinflate and over deflate value of stuff, right? Just, it's inertia. It's, an object that in motion stays in motion, and that works in both directions, of course, until acted upon by an equal and opposite force. In this case, COP, it's going to be in motion that way for a while until acted on by an equal and opposite force, i.e. investors and the flow of capital, et cetera, et cetera. And we'd like to be, somewhere. We don't need to be at the absolute bottom. We don't need to call the bottom, in the same way that we don't need to call the top. We just need to get in somewhere here, and get out somewhere here, and we should be okay. And that's generally our approach.
I like that theory because you're not saying there is one great investment or one terrible investment. It's really case by case. And I've always felt that way, that there's opportunity in every asset class and every market if you know where to buy and where
exactly. Yeah, right. Like, show me a retail deal, which, like, I don't want to touch retail. Like, for, name an asset class and I'll show you a deal that you would want to buy, right? Like, at a basis, Fifth Avenue retail is great. The problem with Fifth Avenue retail is that rents have historically have recently, or, over the last decade, again, been bought up to $10,000 a foot.
Right.
And that's not sustainable. That's not what retailers want to pay today. So I would love Fifth Avenue retail if I could perform out Fifth Avenue retail at $2,500 a foot.
Mm-hmm.
So,
yeah, I agree. So where are you finding most of your deals? Is it through relationships? Do you look at broker networks, kind of where are you finding these unique opportunities? Because it sounds like you really are covering a lot of ground in terms of different asset classes and markets.
Yeah.
And some pretty unique, for lack of a better word, things to take a look at.
Well, we're not finding enough. So to the extent there are any, investment sale brokers or really anyone, who's seeing interesting deal flow, please let us know. We're eager. I would say probably most of our deal flow comes from the traditional, brokerage network that we have. But probably most of our deal flow that we end up executing on is like more concentratedly coming from kind of like word of mouth, just strange places sometimes. I can't say that there's like a consistent recurring source of good deal flow for us.
Mm-hmm. Seems like you got to put a lot of feelers out to find the right one. So I guess that makes sense.
Yeah, it's a lot of underwriting deals that we won't do eventually.
Right, of course.
Yeah.
So we didn't talk about this previously, so I'm going to throw you a curveball just for fun. Tell me your thoughts on financing, interest rates. No one has a crystal ball, but where do you think debt markets are going to go over the next 12 months?
Yeah, so our expectation is not up, and and potentially down, right? People say there's no more down we could go, but there's always negative. Mm-hmm. And arguably on an adjusted basis, we're already in that territory, right? When you account for inflation, arguably we are borrowing at negative interest rates. In other words, we're being incentivized to put money out, and I think we'll stay that way. I think that there's a lot of concern about heading into an inflationary market, but as measured by the consumer price index, that's probably not going to happen. So I think kind of the federal government, the Treasury, can continue to inject a tremendous amount of liquidity into our market without really seeing hyperinflation the way you'd expect it to happen. And again, I'm not an economist, so take all of this with like a ton of salt. But I do think that we're mismeasuring inflation, because we do have hyperinflation of investment product, right? We do have hyperinflation of stocks, bonds, real estate, hopefully to an extent. And when I look at interest rates and predict out the likelihood of them going up in the near term, I have to imagine in a recessionary environment that's probably not happening, which bodes well for real estate, of course, because ultimately, at least in New York City, and at least the real estate that we're doing, but this is true of most real estate in the 21st century, it's kind of a game of leverage, right? So what's that?
I said absolutely, balancing the leverage and the cap rate to get a return that makes sense.
Exactly. It's just this, it's just the positive spread between the money you're making and the money you're paying. Mm-hmm. So I think that
to that, but good insight.
Yeah, I think, but again, that's sort of I hope I'm wrong, because I hope we do have miraculously a V-shaped recovery, and they're just doing so spectacularly that we can inch up, interest rates without the pain.
Right.
Because it would be nice for the future to have, quantitative easing in our, toolbox of repairing an economy, and we certainly don't today.
Mm-hmm. Another kind of interesting big picture question that we don't have time to dive too deeply into, but what do you think really does need to happen to minimize or stave off the recession that we all kind of feel is coming? Is there anything that you think should be done that's not being done, or anything you wish politicians were doing that they're not doing that you think would have a material impact?
There's a lot I wish politicians were doing that they're not doing.
True.
But I guess we all do, right? As if you want to be woke in 2020, you have to be angry at someone. But I also think, I also think that it's amazing how quickly our government reacted to this problem.
Mhm.
And I'm not, praising them for having the right intentions. It's an election year. You can make a lot of arguments about why it's self-interest, but like ultimately, I kind of think everything we do is self-interest. So like, who are we to blame them for being self-interested? But but I but I think it's amazing. I think it's amazing how quickly we sprung to action with imperfect programs that did a lot to float us along. And I mean, it's that same floating that I'm kind of calling artificial sustenance and life support, maybe dangerous life support. But I think if we're all aware of what it is, it's probably doing more good than harm. I think if we're not aware of what it is, then it's really dangerous. I mean, it's kind of dangerous either way, but it's hard to argue that keeping people employed, right? The PPP program, it's hard to argue that isn't kind of, net good, net positive. There are a lot of problems, of course, and to the extent we're unaware that we're, injecting ourselves with this artificial sustenance, this life support, that could be really dangerous. I think like the stock market is an amazing example of like, sort of what happens when retail isn't totally understanding that, that the government is artificially inflating asset prices.
Mhm.
And then they come in and really shouldn't. Like you kind of want, until corporate earnings, reach asset value, right? Like, because corporate earnings fell off a cliff and the government said, okay, we got to keep asset value up here so that corporate earnings can catch back up to keep us from a recession. I think it might be in vain to an extent, because I think that, 40 million lost jobs is too hard to recover from in a month or 2 months. I think that when companies rehire, they're not going to hire back to 100 or 110%. And the companies that are bankrupt, they can't hire back because they're bankrupt. But I think it is theoretically possible that corporate earnings catch up with corporate value. But I think it would take so long that, trillions of dollars has only gotten us this far. How many more trillions of dollars do we need to get to a place where corporate earnings catch up with corporate value? I think like an unrealistically long time to expect that we can do that. But we'll see.
Great thoughts. We only have a few more minutes, so I want to bring it back to real estate and ask you two more quick questions. First one, we are seeing on the brokerage side a lot of activity from private clients. We've actually, on my team, been extremely busy in the last few months. Things have really changed and picked up. People are looking for stability and diversification from the stock market, et cetera. Who are you competing with so far? This might be a little early to ask because we're just starting to see some price discovery. Really haven't seen a lot, but who are you competing with, or do you expect to be your biggest competitors in the market as you look at these true value deals?
Everyone. So typically when we sort of, hone into a thesis, we like to find two things. One is, a thesis we find very compelling, and it might be because we think it has really strong tailwinds. It might be because we think the market overpunished it and it's deeply valuable. And the other is a dearth of competition, right? It's better to not compete. We don't have the latter in almost anything these days. It's really hard for us to find something super niche or, kind of like obscure enough. And we'll see if that changes over time. But like, kind of the obvious places to find deep value today, like hotel being an example. It's just hard to imagine we're going to win too many of those deals because I think there's such a surplus of dry powder capital on the sidelines, probably with a cheaper cost of capital than ours, right? With lower yield expectations than our investors have. That'll likely beat us. And maybe they have more bullish underwriting than we do, right? Maybe they're expecting, recovering to pre-COVID RevPAR more quickly than we do. Maybe they're, underwriting tax reduction because, because hotel income drops. Maybe they have just more bullish underwriting. But even if they don't, I think they have cheaper cost of capital. and there's just so much of it. So that's that's a scary problem for us today. I think our feeling is like there maybe isn't enough to go around today, but there probably will be, unfortunately.
Mm-hmm.
Right?
So patient capital.
Yeah, and like again, we're trying not to just sit on our hands, so we're waxing the board and we're stretching, and we're taking it out for like a test drive every so often. Now I'm totally revealing that I'm not actually a surfer because I just said test drive. I don't know. We're taking it out for whatever. On a gnarly wave. Yeah.
Exactly. I will tell our listeners or viewers that I think you're being extremely modest. You guys have a really impressive track record of achieving returns when others couldn't. So I would say to any brokers listening, anyone who has some unique opportunities, we'll make sure that you have access to Gavriel's contact information because they are very creative and very successful in the market. So absolutely send deals Gavriel's way. We'll make sure you can connect. Last thought before we wrap up, switching gears, we have a wide range of real estate people who listen to Red NYC. What advice do you have, and this is a tricky one, for anybody who's newer in the industry, could be on the investment side, the brokerage side, any of the third parties? What should they be doing right now if they're, let's say, in their first 5 years in the industry? Any advice?
So I think the advice today is probably different than like kind of the advice I would normally give. The advice I would normally give is like overextend yourself. Reach for something that is out of reach, because it's in that pursuit that you really grow most quickly, of course. I think specifically today, I would say, to the extent you can, be patient and learn and understand the interconnectivity of, kind of the economic web that we're in. Because I think a lot of real estate investors kind of put their blinders on and just say like, real estate for dummies. I have revenue, I have expenses, I have NOI, I have leverage, and here's my yield on cost. Great. That's totally true, which is why real estate can be so fun, because it is a relatively, repeatable set of inputs. But I think where it gets interesting is where you understand special opportunities. And I think those are only revealed when you kind of get the broader framework that you as a prospective investor are sitting in. And of course, sorry, this is a little specialized to investors, which is unfair. I think in general, what I would say about today is now is when people made their fortunes, right? In other words, this has happened before in history. Mm-hmm. Everything we will experience, a version of it has happened. A collection of different things in history are very similar to what's about to unfold. And the same is true today. And it's certainly the case that within the real estate industry, people have made, investors have made, sponsors have made, brokers have made, careers out. It can be an exciting time. It's a scary time. But don't think it's over because it's not. Get in on the bottom because it's going up. And and really try to educate yourself as much as you can, not just on real estate news, but on kind of the world at large, because it's an incredibly interconnected place.
I think that's a great point. I completely agree that you can no longer stay in a silo because everything is so interdependent. Very interesting. Well said.
Even as we head towards nationalism, unfortunately, still the case. We're all connected. We're going to stay connected. We can't fight it.
Exactly. Unfortunately, we are out of time. Would love to continue the conversation, as I'm sure we could. Want to say a huge thank you to you, Gavriel, for sharing all of your insights.
Thank you, Carly.
To Selman and Red NYC for giving us this opportunity. And for everyone listening, thank you for tuning in. We wish you all a healthy and productive end of the summer and rest of the year. Hope to see you soon.
Thank you.